Hey, everybody. Welcome back to Market Mavericks. Yes, there's been a little hiatus, but we got the three amigos back together finally. How are you guys doing?
Good. Hello.
Doing great.
Good, man. All right. So Scott was out away gallivanting all around the world, so it's not the Market Mavericks without you, buddy.
It's my fault. It is.
I know we had to needle you a little on that, but just
yeah, of course. I deserve it.
But it's great to be back, guys. And let's without further delay, let's get into some of this action here. So I guess let's start with the economy. We got GDP numbers out this morning, Mike. It was a sharp drop from expectations. I think it was 1.6% versus 2.5% expected. And I was surprised initially to see yields surging. I was like, oh, this is weaker data. Isn't this a negative? Doesn't the Fed want to cut? But instead we saw yields surging. Can you explain what's going on here?
Yeah, I showed it on my screen right now, and the GDP annualized came out at 1.6%, expected 2.5%. The first shocking thing about that to me was, when's the last time we had GDP that came out less than expected? They've been up, higher than expected. Of course, it'll be revised now, but on the screen I'll show you GDP price index was 3.1 versus expected 3.0, and the PCE price index was 3.7 versus 3.4, so much higher inflation than expected. So stagflation is definitely not good for stocks. It's also at that stage where everybody's debating whether, okay, is this just a bit of a correction to buy, or is this the bigger, at least 10% correction that some of us guilty here have been looking for? And I can dig into that in a little bit, or we can just banter around.
Sorry to jump in, but just a quick fire on this. So isn't tomorrow the PCE data? So what PCE data came out today that caused the market or yields to jump?
Yeah, that's right. I'm showing you the screen. That was one from the quarter over quarter GDP, and it's high related. So hey, tomorrow I'm showing you how we have PCE. The deflators expected 2.6% annual basis. A lot of people watched the month over month at 0.3%. That's all the stuff that works. The core deflators expected 2.7. That's what we're seeing tomorrow.
Gotcha.
Tomorrow. But it's already pretty much forecast.
So basically, and again, correct me if I'm wrong, but basically what's going on here is that the market's freaking out because the economy is weakening, but inflation is still moving higher.
Mike, can we just really quickly explain stagflation? I just like to not take for granted that everybody knows what we're talking about. The last time we had extended stagflation obviously was the 70s, but you're talking about basically unemployment rising. That's the part we don't have yet necessarily, but high unemployment, inflation, so prices rising, and slow growth. So you have this situation, which is a Fed nightmare because they can't cut and they can't raise, because both of those will push a lever in the wrong direction for one of those things. So I just wanted to be clear to people what the problem is if we have a situation like that.
And just to even explain even a little further, so usually during inflationary periods, you have a strong economy. So people are making more money to offset the rising prices, right? But in a stagflationary period, your people are losing jobs, they're making less money, and prices are going up. So they can't afford those rises in prices. And that's why stagflation is so bad.
Yeah, and it's a key thing that Scott said. Fed can't tighten. Or Fed can't ease. You can't ease in stagflation because their job is to keep interest rates low and unemployment low. So they're stuck. But it's, in my view, it's a blip. It's a blip. It's all contingent on one thing. The stock market has to go up. And it's not a coincidence that we had this pretty sharp rally in the stock market the last 12 months, up 26% total return. And inflation sticky. We had crude oil bounce and inflation sticky. And we also had all the Fed rate cuts coming out of the market. That's just not coincidence. It's the most, I think we're at that point, and even some economists would say, where the stock market is the most significant it's ever been in terms of inflation expectations and risk on and animal spirits. I mean, it's just completely directly correlated. You need the stock market to go down, basically, I think, for the Fed to start easing this way. So,
yeah, no, I'm in the same camp with that. I think you get a 10% plus correction in the stock market, and we quickly see a rate cut. That's at least my guess. But yeah, it's certainly going to be interesting with the PCE data tomorrow. I mean, gold's pulled back off of its highs. We've seen silver pull back off of its highs. Oil is still holding relatively close to its recent highs, but we've seen, China is trying to get out of the hole that they're in. Where do we see? Are you thinking, Mike, that we're seeing this correction? We're already in the midst of a 10% correction. Are you thinking?
Yeah, well, I'm biased. So let me show a few charts on that. This is the main one I think that matters. It's just a chart of the S&P 500. People have seen it from me before. And it is basically correcting potentially. We're going to go back to that gap we left. This is the S&P E-minis. And most people, and the key thing has happened is market started rolling over or went higher. It's taken out all this Fed easy, and this is Fed fund futures in 1 year. It's just going back up towards par, but also at the same time, commodities are rolling over. So it's all happening, and there's a good reason for that. It's historic. I see almost a 20-year low in volatility. And this is one thing I show you here. If you take the VIX volatility index, the 52-week moving average, minus subtract out the T-bill rate, which shows the high T-bill rate. See that bottoming process here? It's extremely low. That's an environment you say, okay, I don't want to be overweight equities when T-bills are really high and volatility is really low. And how high and low is it? It's probably bottoming like it was around 2018, when the last time it did that was basically 2006 and 7. That's part of the reason I think I show you here this gold crude oil ratio is going to pop up from around 30 to 60. It's not a lot to expect, 3,000 gold, $50 crude oil. And this to me is one of the key charts that's showing what's happening. We're starting to see that convergence where if you put the price of gold per ounce on the same scale as S&P 500, they're just starting to converge a little. S&P 500, this dip so far is absolutely nothing on a big picture. It's nothing. Go ahead.
No, I was going to say, so we're talking about a weakening economy. And the big question, Scott, is, are you still holding your TLT?
I am.
Awesome.
So, I mean, to me, that's a longer term hedge position. I caught the bottom and I'm just not going to get shaken out of it based on, day-to-day data or whatever. It's not even something that I've been tracking too closely. Now I got to look at 87. So yeah, I'm in at like 84. Yeah, there was some profit to be taken there, but like I said, it's a hedge. If we go into a recession or we get a great reset, probably be very, very happy, that I'm holding that. So I'm not particularly concerned.
Yeah, in fact, I actually loaded the boat just in the last week or so here as we've been down in this lower range. I have this beautiful channel, and really this is a bullish pattern, right? I mean, you could call it a cup and handle pattern, you could call it, anything, but ultimately this trend line right here is where the key is, at least on price action. So I'm actually expecting TLT to make a push up here, and I think that jives with what you guys are saying too, in terms of potentially getting a weaker economy as the stock market starts pulling back. I mean, you think about some of these losses in market cap. And last week, Nvidia dropped $200 billion today. Meta, I think at one point it was down $200 billion. Now I don't think it's down 19%. As much.
Yeah, it's down 19%
huge
overnight.
drops. And these are massive positions in people's portfolios that were making them feel ridiculously rich so that they could spend, thus implying that inflation was going up. And now you have that reversion kind of thing going on. So it should be fun. I mean, it's certainly volatility is starting to return. The VIX is not in the 20s yet, but certainly something that I do expect in the not too distant future. All right, so quickly turning our attention, Scott, give us a rundown of what is going on Bitcoin and in the crypto markets. Where are you looking? Are you looking at a bigger pullback than what we have right now, or is this bullish consolidation for the next breakout?
Yeah, here's my chart. And it's funny, I did a stream this morning with Mike Alfred and the title was $90,000 Bitcoin. And we were talking about how that was possible, in a few months. And I don't think I've ever gotten angrier responses about a bullish title. And I've had much more bullish titles than that, which indicates to me that people are really already losing their patience with no new all-time highs on a daily basis and already thinking we have to go down and already getting exceptionally bearish. And we see the euphoria at the top of ranges and the panic at the bottom of ranges. But if you look at Bitcoin since 17,000, I mean, to me, the bear market ended at 25, the first new high, higher high. So you've just had big moves up, consolidation sideways, sometimes for months, big move up, consolidation sideways. So until proven otherwise, this is a big move up and we're trading sideways in a range. And people are panicking every time you get to the bottom of the range. Tale as old as time. I mean, it's like Beauty and the Beast. I even made a joke about it on Twitter today. I made this chart, WAG me for those who don't know, is we're all going to make it. So every time we're at a high, we're all going to make it. Every time we're at a low, it's over. High of the range, WAG me. Low of the range, it's over. And over and over and over again. And I can see it in the sentiment. So right now, actually, this morning, I literally got on and people were panicking. I said, I'm kind of bullish. And it went up today. I'm not saying that's the reason, but you can set your clock to the stupidity of Twitter and YouTube trolls who are over emotional and, probably over leveraged or just not exposed. But I mean, this is a nice little higher low potential reversal candle right now. And we've had some bad news, right?
Yeah.
This should be a terrible candle if Meta drops 20% and we're a tech stock. We're not. This should be a terrible candle if gold is seeing a retracement. We're not. This should be a terrible candle with bad economic data. It's not. I don't think it matters on a day-to-day basis, to be clear. I'm just saying Bitcoin just going sideways. We don't need to figure it out every day.
Yeah, and I saw that. Also, I saw your tweet about that too. Is that it's not correlated anymore to risk assets, and I think that's an interesting hypothesis. It sometimes appears to be, but I think it's in this interim period where you're right. I think it's slowly decoupling as people are now looking at more and more.
Yeah, I just think correlation has to be specified to a time frame, and people don't do it, so it's confusing. Same with bullish or bearish, right? It's on a time frame. You can be shorting something you're bullish on for a day if you think it's going to go up forever, and it's just very confusing. There's times when it's correlated, of course. If you have big events, all correlations go to one, and then they, unhinge once again. And for now, I think it's just kind of chopping sideways.
So it's about the big test, and that is right now Bitcoin is bucking beta. We have to. Certainly lately, and the key levels I think about, and I showed you my chart, is like 5,000 S&P 500 and 60,000.
Agreed.
On Bitcoin. If we get the S&P 500 break below 5,000 and Bitcoin stays above 60,000, that's a pretty significant sign that Bitcoin's bucking beta. That would be a good sign, but we still have to get through the big test. And we all know they're all off from the record highs. And as you said earlier, we both expect, Scott, I don't know about you, expect that 10% correction S&P 500. It's nothing. Let's get through that and see how Bitcoin responds. Right now, that's where it is. To me, that's why I show you this chart. And this is auto-scaled on these Bloomberg charts to, I have to go back to like September 2021, and it puts these as the key support levels right now.
Yeah, I was just going to say, and Gareth touched on this earlier, Mike, but I have the chart up. Gareth, you just want to bring it up. I literally was just wanted to calculate. So this is S&P, obviously SPX. It's seen 6% right at the bottom there a few days ago. So 5.91%. But if you look at the Qs, we've already gotten that 8% retracement, right? So I don't think, maybe I'm wrong, but I don't think 10% is going to move the needle with policy. I think we'd actually need to see a much bigger retracement. If we've already gotten to 8 on tech, I think you got to be talking about 15 or 20 for the Fed to really take notice, because this 8% on tech has kind of been a nothing burger as far as perception. I think most people don't even know it's down, to be honest. They haven't even probably looked.
Yeah, no, I actually think you're right about that, especially tech. Tech is definitely more volatile, and I think it probably has to be down closer to that 20 handle before it really forces the hand of the Fed to cut rates. So in terms of just going back to the crypto side here, a lot of these altcoins have fallen like 40-50% from their highs. Like, is the altcoin bull market not happening, or did it happen already? Because all I heard for the longest time is just wait, the altcoin bull market's going to come, and then these stocks drop 50%.
Yeah, I mean, I think that we've had some, I think that we've definitely had some individual big price moves still to the upside, even in the context of these drawdowns. But listen, I've been tweeting about it for a month. Was getting the classic eviscerated. I'm trying to find it. Here you go. Right. I said this on March 18th, and my opinion hasn't changed. That's 5 weeks ago. I have some concerns. Top signals I would normally look for when I'm not FOMOing or present. Meme coins going insane. Huge run on alts to historically overbought. Bearish divergences showing across the board on high time frames and max greed. So every single I would look for when I'm not in the market was there for a top when we were in the 70,000s, right? Yeah. And that's for altcoins as well. So none of this surprises me. But I will say now, if we're talking about sentiment, as I said, we've seen a flip. The same euphoria we had at 74 for all of this, I think we're getting that same panic down here in the low 60s. So I think we're going to start to see alts move again. And I think I haven't looked. I mean, I have this, but I know that even the memes had started pumping again. I'd seen, maybe it was yesterday, the dog with hat was up 20 or 30% or some of these things. So the second that there's any glimmer of hope, the degens go right back at it, But I think that, listen, this was a very natural time with the halving and narratives for us to just cool off and scare some people out of the market. You can't go up forever, and you can't let people win at the casino, which is what the meme coin market was and is. Can't win forever. They got to get washed out, and then you got to get some new blood.
Yeah, absolutely. What do you guys think about the moves in other commodities? So there's commodities like cocoa up insane amounts. There's coffee that's been on a bull run. I mean, the move in coffee has been actually incredible to the upside. Kind of not as talked about as cocoa here, but We've had this huge breakout here. We're getting a retrace. I mean, Mike, are you thinking like, are these commodities all going to come crashing down, or is there some legs and further upside here on something like coffee or cocoa?
Cocoa will, if history's a guide. It did the same thing to the peak in 1977 and took it out this year. It had some pretty good technical signals that some of us are all over that did really well. But at 10,000, it's going to break down. Coffee, it's just a matter of time. It's how commodities work. They're not like equities. They go down because they want to go up. They go up because they go down. They're very autocorrelated. I can show you a little chart on broad commodities. I'm going to show you. I think broad commodity market is significantly peaking with 5% two-notes. That's what I show you in this chart. We have the two-note peaking around 5% or touching 5%. To me, that was the level last year. That was the level that yields peaked. That's when crude oil peaked, and that's when commodities peak. And that's the same thing I show you here. It's like it's all peaking right there at that level. And let's look at the most significant commodity on the planet, WTI crude oil. Managed money net positions in petroleum got to near 15% of open interest. Those are hedge funds. See, the last time it did, that's when crude oil peaked last year at 95. Now we have managed money net positions peaking about the same thing, 15% of open interest, and crude oil's peaking at 87. So I see that with two-notes as signs that everything is potentially peaking. And there's one key thing that's happening. That's the convergence, the macro big picture of CGBs, which is Chinese government bonds, with JGBs, which is Japanese government bonds. And the key thing that we'll look at is the Chinese 10-year note yield at 2.26% is the lowest in our database for about 20 years, back to 2006. It's collapsing. It's one of the best indicators in the big picture of deflationary recessionary forces from the world's most significant demand pull source for commodities. So you can listen to what they say. The rules is you ignore what they say. It's just, particularly in an autocratic society, has a vested interest in telling the narrative, and watch what they do, or watch their bond yields. Their bond yields typically don't lie. That's a sign of deflationary forces from China.
Is the yield curve still inverted, or is it? I mean, I think it is still inverted, but is it starting to narrow at all? I mean, we know that recessions usually are triggered once that inversion uninverts, right?
Yeah, so that's usually what's happened. So I like to say, if you look at the U.S. 30-year yield at 4.81 is what, 25 basis points less than the Fed funds, around 5.25, 5.3, and then the 10-year note too is about that much. And then you look at the rest of the yield curve out to the rest of the world. The next largest country on the planet in terms of GDP is China, and their 10-year note yield is 2.26%. That's half of our T-bill rate. That's a pretty significant global economic sign for deflation and recession. Yes, it's been delayed significantly, so partly because of one reason: massive fiscal stimulus in the U.S. And of course, we've had this little wealth effect pickup in the stock market, but that's where I think everything tilts over. I've never seen the inordinate burden of the U.S. stock market going up more significant than now, ever. Meaning the stock market has to go up. Otherwise, if the U.S. stock market tilts lower, those deflationary dominoes start trickling down hard. And curve shows it, commodities show it, and everything else is kind of holding and waiting on that.
So what are, for both of you guys, like, what are some of the biggest risks right now? I happen to just bring up the dollar yen chart. Holy cow. I mean, talk about a breakout out of a big wedge going back to early 2022 here. But I mean, like, what do you guys see as like the potential black swan situations and maybe Mike, you could even explain to the viewers, like, why is the dollar yen going up like this? Is that a negative? And if so, why is it a negative?
So I want to start with that. It's the unstoppable force of the strengthening dollar that is breaking things on a global basis. So first, look at U.S. interest rates, 5%. Virtually every other country in the world is below that. In fact, they can't wait to cut in Europe. But why can't they? Because they have the U.S. interest rates are so high, their currencies are going to collapse. The dollar is unstoppable at the moment. And then you go to things like cryptos, you can see the dollar's been adopted. So to me, that's the problem, is the dollar's too strong. And that's the history of the dollar. Now, people poo-poo it has this decline over time. It has over versus gold and Bitcoin, but versus a basket of other fiat currencies, particularly the yen, the dollar just goes up. And that's the problem for the whole world. To me, and I'll trigger over to what's the biggest problem with that is that's part of the lose-lose for all risk assets. You see that chart? What's really been driving the strength in the dollar since the 2011 bottom or so, is the outperformance of U.S. stock market. Now, the U.S. stock market is at the highest ever versus the MSCI ex-U.S. It's the highest ever. It's 25-year high versus commodities. And there's the problem. The U.S. stock market basically has to start underperforming or go down for the dollar to go down, which is the lose-lose for all risk assets. And that's what you show there is now the Japanese, well, that's S&P 500, but the Japanese have to intervene. Their economy, their currencies collapse. And just think of the price of crude oil in their country has like doubled this year. And they're very much demand pull importer of commodities. Everything's getting expensive in terms of things they have to import because their currency's melting.
Yeah. What I just brought up here is the S&P versus the Hang Seng, and you can see the divergence there is just I mean, that is incredible, that divergence in those two stock markets. And now, would you say that there's a potential for a reversion here where the S&P falls and the Hang Seng, let's say, rallies and then kind of meet in the middle?
Well, the Japanese have been significant buyers of ETFs in Japan, and there's very little reason that China should not do the same. In fact, there was recent a Trillions episode, which is our ETF podcast. The Chinese will start buying their own stock. Why not? I mean, they should. That's how they're going to help solve that problem. That's what you fully expect. That. So I fully expect to have a tradable balance in things in like the HSI. The Chinese are probably already buying their own bonds. And they're probably buying copper. They're certainly buying gold.
Yeah, gold.
And why not stocks? Look what. So they're in a severe deflationary force. You can't really see it in their data, but in their like you see there in the stock market, you have it. And that's how did the U.S. end the significant deflation of the 30s? We debased versus gold.
Oh, wow. All right, Scott. So give me some of your risk factors. Like what are some risk factors for the economy and maybe even for crypto? Like, I mean, all right, so potential 90,000 on Bitcoin. What could derail that?
I think there's a lot of things that could derail that. As I said, you're uncorrelated until you're not. So if we see some sort of black swan with the economy, I think that obviously that could put some pressure on it. I think, if there's I always joke that, the best marketing for Bitcoin, the best thing for prices is higher prices. Right. Yeah. So, but that goes the other way too. Right. So like if we start to break and close candles below 60, you start to see those new ETF entrants start to sell off a bit. Maybe we, push down into the low 50s, high 40s. Nothing would surprise me. 30-40% retraces. But listen, I don't think there's anything glaring right now within the crypto sphere itself that could send us much lower or stop the cycle. But that doesn't mean that I don't have strong opinions loosely held and that something could change that. I mean, listen, if we literally enter a period of stagflation here, and that becomes very clear, I have my doubts about the data presented and whether it's real or not ever at this point. But I think it's going to take a hell of a lot of headwinds to stop Bitcoin with the narrative, even if it's just animal spirits of the halving and ETFs in an election year, before potentially the end of the year or Q1 next time. I kind of feel like, honestly, my case now, it's one I made before, is like, maybe it's just really boring for a few months. And that includes some lower prices and some higher prices. But I also wouldn't be surprised to see that 20% correction in the stock market through the summer when it's not a huge risk for the election. And then all of a sudden we ramp up and are talking about a stock market pump in September, October, and November, just in time for the election. So I think we could see some real shenanigans in the next 6 months for sure.
Do either of you guys view the elections as being a potential black swan? Like, is there something that could happen that would freak the markets out? I mean, and I'm not saying which candidate wins. I mean, I'm just saying, like, are there repercussions from something? I mean, we saw, January 6th, we saw other things like that. Or is this more of just something to get through and then start looking at other factors like the Japanese, the dollar yen, and these are the other bigger, more important things?
Remember Chad? Something like that. A contested election is a big problem. I think it's more the latter. It's something to get through. And the key question we had at the Greenwich Economic Forum in Miami, and my panel was, okay, is there going to be Trump 2.0? And what does that mean? And polls are kind of heading that way still.
Yeah.
I mean, I don't think that I think it's going to be a wild time. Right. Between AI and lack of trust in media and government and inevitably people questioning the election results. But I also think that's what's priced in now. I think we've become such a nonsensical society, and that the market just shrugs most things off and continues on because it's always nonsense. So
yeah,
I more think it's something to get through, and then we'll see. I mean, here, the other black swan just in the world, obviously, is maybe Mike can push back. I don't know. But $1 trillion every 100 days added to the debt seems unsustainable. And it seems like they're just quietly trying to keep doing that in the background to keep things propped up. But that rent comes due eventually, and they're going to have to refinance that debt. And I cannot comprehend how they're going to do that.
Yeah, and think about
maybe
the
I just
rates.
don't know. Maybe I'm not a macro economist, an economist. I don't know. But just
you mean you don't believe in modern monetary theory?
No, I'm not a big MMT guy.
Well, that was part of what I heard come out today when we saw these stagflation type numbers, where people are saying, well, what do you expect when the economy is completely dependent on government fiscal stimulus for survival, and at the same time it's keeping the Fed tightening, or keeping the Fed tight? That's just a poor trajectory, and that's obviously what favors gold and Bitcoin, and like you said. But what I see going ahead is tremendous trading opportunities, and the things I see from very low volatility, very high interest rates, and yields plunging in the rest of the world. It's becoming less of a buying hold for risk assets.
One more question, and this just popped into my mind, but we've seen earnings coming out, right? Pretty much every day today after the close. Google/Alphabet and Microsoft, Intel's reporting. Yesterday we had Meta, obviously, and we've seen a lot of good earnings that are beating estimates, and then the guidance is very, very weak. Is that an indicator of something bigger on the horizon, or are these companies like just talking down their numbers so that next quarter they can beat them by a mile again? And again, I ask that because we're all kind of watching to see, are we going to have a recession later this year? Maybe this is an indicator that could be happening.
Is that like when golfers go and they juice up their handicap and play really badly before a tournament so that they can come in with a higher handicap? Yeah, that's why.
So the CEOs can get their bonuses and make themselves look even better. I don't know.
But what do you think of that?
Yeah.
Scott, that's yours. You go ahead.
I think anything's possible. Certainly.
I think Mike's in a trade. He all of a sudden got very focused on something.
No, I'm actually trying to scale this. I was trying to see if this month is an outside month down in the S&P 500. It is in E-minis, but the actual index did not take out last month's high, and still below the last month's low. So I'm just kind of playing with the signals that I usually will watch, and they work great until you trade them, and then they don't work anymore.
Gotcha. All right. So Scott, so to you then, do you think that any of these weak, guidance things are anything more than CEOs talking down their numbers? Do you think there's something to it?
Well, I do think it's interesting that Meta dropped 20% allegedly because Zuckerberg showed up and said, we're spending more on AI than we anticipated. Mm-hmm. And that was the reason. And if you remember, the way that Meta really finally bottomed was not because they showed more profit potential or because the business was growing. It's because they cut a shit ton of jobs, pardon my French. And basically, the best way to make money is to save money mentality. Yeah. And so it's that they're spending more on something that I think everyone actually objectively thinks they should spend more on, being that AI is the future, and that rocks the stock 20%. So I think to some degree, when you just dig under the hood of these things, the companies maybe aren't doing that much better, and the stocks are moving based on how much they're spending or not spending over any period of time. And that to me just gives me a bit of pause. I don't think that's the best way to value a stock.
Yeah, no, I agree. And in fact, IBM.
But you're describing frothy stocks.
Yeah, exactly.
Yeah. And I was just going to point out that IBM missed guidance by a little bit, but then they announced a buying out of another company, which again, the idea that seemed to really be a negative, as they're obviously spending billions of dollars to buy another expenditure, right? So it's just interesting things there. And then we can't forget Chipotle, man. I mean, I don't know how many of us eat there, but that stock just keeps going up and up and up.
A lot of burritos being sold.
Yeah, that is a lot of burritos.
A lot of stomach problem. I would love to see the stock for Pepto-Bismol if that's following the Chipotle, but
cool, guys. All right, well, I think that's a great place to end it with a burrito blowout. So let's call it a week here, or Market Mavericks. I thank you guys. Socials are at the bottom, guys. Make sure to follow everyone here. You guys are awesome. Always bring the A game here for our amigo group here. And hopefully, I'm not going to guarantee it, folks, but I'm hoping we're back next Thursday. We'll check in with Scott.
I'm back. I'm back for sure next Thursday.
Then we're back.
You guys choose to do it. I can't tell.
All right, guys. Thank you so much for tuning in. We'll see you all soon. Take care.
Bye.